Good evening, my fellow Riz Elite members. This is Chris with Riz International, and this is your weekly market recap. And tonight, I'm joined by the man with his name on the side of the building. That's right, it's Riz himself. How you doing tonight, buddy?
Doing great considering how things have gone this week. Can't complain.
It has been a wild, wild ride this week, and we've got a lot to talk about. I'm sure that you all have a lot of questions here who are here with us live right now, and we will get to all those questions at the end. Trust me, we have an action-packed discussion ready for you tonight, so I'm sure you're all ready for it. But let's take a look here at the S&P 500, and holy cow, Wednesday, Thursday, Friday, ouch. That was rough. We completely busted through my support line that we've been holding to fairly tightly for the last several months, since about November. Riz, is this a sign of things to come, or is this all just fallout from everything that's been going on with these meme stocks?
Yeah. It's wow. Like you said, you actually nailed that. It's a fantastic support chart there, Chris. But yeah, I mean, this is I was cautious from last week as we were getting toppy, and this week has kind of been quite bearish for obvious reasons, and we will get into that in terms of market structure and overall. But right now we are hanging on that support. You have it defined as the 50-day moving average, and I think that is a key level. In one of my quick little videos for elite members and social media on Instagram, I shared a video of sort of levels that I had also identified. One of them is at the 50-day moving average, and then a few levels below that as we go down to 3650, 3675 area. So no, I think this week I think is going to be another action-packed week. We will see a lot of things shake out. We're going to see a lot of political commentary. We're going to see a lot of commentary from everyone and anyone. Okay, it doesn't matter if if someone has a kid who's 13 years old, 15 years old, or someone who has a grandparent who's 60, 65. Everyone has heard about this. It's gotten mainstream. And of course, I'm talking about GameStop stock, and of course, all the fallout that's occurred because of it, plus all the other stocks like AMC, Nokia, BlackBerry, Bed Bath and Beyond. There's so many now. Cost. There's so many that have just kind of rocketed and pumped. Really, I have no other word besides saying the word pumped, because that's what it is. It's a massive public open pump of various different companies, and not all of them are because they have high short interest. So that's something that needs to be clarified as well. Not all these companies that are pumping have high short interest. Some of them have very minimal short interest, but they're being pumped nonetheless.
Yeah, and we will get to that here in a minute, guys, after we go through our market recap here real quick, just to cover what's been going on. So let's take a look here at the breakdown. Obviously, we had a big surge in energy to start the year with oil pushing up to a pretty nice level around the $50, $54 a barrel mark, and we'll take a look at that here in a second. Since then, it's kind of been rolling over, and the market's been kind of coming down too. I want to talk about energy for just a minute. Obviously, the current administration here in the United States is really pushing for more clean energy initiatives. Riz, do you think that this pullback, I would say, in the energy sector is due to those executive orders, or that potential for that to happen?
Yeah, so we've heard talk about, obviously, more EV, more electric, more clean energy. So that's definitely a sector that is looking on the up and up. And I mentioned that the last time I was on a couple of weeks ago. But with oil, keep in mind, oil has rallied off of a strong $50 area, support area, and this is not uncommon, for commodities. Oil is a commodity to kind of go up in cycles, right? So a lot of people are mentioning a commodity super cycle. All that means is they're referring to the weekly or monthly chart and seeing commodities as a whole break out from their long term kind of drop, right? So that's what they're talking about in terms of commodity super cycle. I think base case of oil per barrel being about $55-$60 is kind of the equilibrium that still stands. We did, of course, see oil pull back along with everything else for the most part, since the start of the year, but oil had the biggest slide, as you can see. And I'm keeping an eye on these kind of sectors, but for now, not the biggest concern. We will get a better idea once there is some uh, calm and I would say normalcy in the market. Right now, these kind of things go out the window, whether it's commodities like oil or whether it's different specific sectors. Because if markets are spooked, as I have said since middle of last week, that is bearish for pretty much every sector, right? So it's something we will be keeping an eye on this week.
Absolutely. And as you can see, guys, here by the bright red line, where the S&P 500, represented here by the SPY ETF, almost flat on the year. From the start of January to now, we're about done with our first month of trading. And actually, by Monday, we will be. So, yes, we are done with our first month of trading here in 2021. Just to take a quick look back at where we've been over the last year, even though we're flat basically for the month of January, do understand the S&P 500, even though with this huge downturn with coronavirus from last year, still up 13% over the last 365 days. So, these kind of pullbacks and corrections will happen. So what I'm trying to say here is I don't think we need to be pushing the panic button just yet.
Yeah, absolutely. A lot of people are always panic, crash, or bubble. There's only these two words that you see, especially from large media sources, and everyone and every, Tom, Dick, and Harry. They don't know anything else besides the two words, crash and bubble, right? So I've said it in the chat room. I've said it to our members and even on social media. The reality is always somewhere in between, whether it's markets, whether it's sentiment, whether it's politics, whatever. Usually, we have to be very, very careful when we are kind of exposed or leaning towards one extreme or the other. Okay, because that's what gets hits. That's what gets people clicking. But reality is not such. Reality is not extremes all the time, contrary to what people think. Right. So this isn't the end, or this isn't a crash, or this isn't, oh my God, everything's going to implode and we're going to have a bigger crash than March. No, it's just another 1.5-2% pullback from already nearly all-time highs. Okay, in what is arguably still kind of like a pandemic type of situation. We're still waiting on vaccine, related cases to come down, but also vaccine adoption and inoculation to go up. So we're still in that, right? We're still in that, and Q4 earnings that have come out have actually been pretty decent overall, considering everything. So it's not game over. It's not the end. We need to see this through. We need to see how markets continue to react to this, because this is an ongoing thing.
Absolutely, guys. Just keep the big picture in mind. I think that's the big thing here. It's like these small things. When you look at these three candles here on the S&P 500, you're like, oh my gosh, it's rolling over. When you look at, the last year, it's not so bad. So just keep an eye on the prize, guys. What I'm trying to say here. Speaking of commodities, which Riz was talking about here, let's talk about those commodities, as Riz is the oil tycoon, as I like to refer to him as. We had this really nice push up in oil since about November, when the market started to really ramp up for quite a while. We have kind of flattened out here over the last 2 weeks, I'd say. We were pushing up really high. It looks like we got to about 52.60 almost per barrel, and that's where we've topped out. And we're really just kind of consolidating here. Is oil just kind of stalling out with the market here, or are we looking for more directionality anytime soon? What do you think, Riz?
Yeah, so $50 I think is a good area for support right now. I think what we see with oil going forward is, as we lead into the spring and summer type of months, that's going to be very, very crucial. Again, every few months we have OPEC meeting as well. So right now they've done a good job in terms of stabilizing oil and not pumping too much, or also not in terms of cutting supply. They haven't done too much of that. They're just kind of holding form. So that's fine. I think $50 is fine. I think we're going to see some consolidation continuing. The more positive news we get on the vaccine front, if we get more distribution of vaccines across the world, not just the US, that bodes well for oil, right? Demand is still going to be there, even with all this EV, electric, green energy. That's fine. It doesn't necessarily mean oil is going anywhere just yet, right? Maybe not, positive trajectory for the multi-decade look, but it's not going anywhere. Oil is used for everything from, even clothing, right? So clothing, a lot of people don't know that, some of the clothing that you wear, the synthetics, there's plenty of things that oil and oil related byproducts are still used for and will be used for. Plastic, plastic is one of the biggest things we continue to use as human beings in our daily lives, and that's also a component of oil byproducts. So it's not going anywhere, contrary to belief. So $50 a barrel, I think, is a great spot. It's a good spot. I don't think we need to be too worried about oil dropping into the 30s anytime soon. And I think if I say base case, $60 is still one of my kind of areas where we see oil getting to in the near future, probably around summer.
Do you think we'll be taking any oil plays in Elite anytime here soon, or are you still kind of being a little cautious with that?
So I have a core portfolio of oil holdings, not just oil, but as part of my investment portfolio, I continue to have some oil exposure via Exxon and via Royal Dutch Shell, and of course some midstream pipelines as well. So my exposure to oil is there. It's been a little bit less than, let's say, middle of last year, but it's still significant by any kind of comparison. So I'm not kind of I would say just completely closing out my oil positions or just getting out completely, right? So I have those. Those are the key major companies. Whether you're looking at Exxon, whether you're looking at Royal Dutch Shell, for pipelines, you can consider TC Energy, TRP. You can consider ENB, Enbridge. They're some of my favorites. Both those are Canadian. But for the US side as well, EPD, Enterprise Product Partners, is also another good one. So there's some solid opportunities in the pipeline sector, because guess what? Pipelines are not just for transporting oil. It's also for transporting natural gas. Many places across the world, especially in the US, North America, I should say, is dependent on natural gas as well, right? So natural gas is also an alternative energy that we use in our houses, so on and so forth. So that's not going anywhere, right? So I think it's a great, safe, conservative, long-term play for having these pipelines. And if you want to be a little bit more aggressive or bullish on oil, then you can directly go with Exxon and Royal Dutch Shell, because their dividends are still there. I'm a bit iffy on if the dividend can be sustained, but for now it's still great. In fact, Royal Dutch Shell increased their dividend a quarter or two ago, right? Even in the midst of oil kind of dropping and the pandemic. So that's also good news.
Absolutely. No, and I think that's the important thing. Is I think I said on our last video that we posted, I don't see jet engines being powered by batteries anytime soon, guys. So until we get the arc reactor from from the Marvel universe, I don't think that's going to be happening anytime. So
yeah.
We're going to have to. Oil is, even if we do see a heavy push towards EVs, electric vehicles, we're still going to have oil around, guys. It's not going anywhere.
Yeah.
Let's shift our focus here to gold. Now, you may notice that I have changed our technical analysis here on gold. Before, we were looking at the downtrend that we're seeing here from about August after this huge push on gold. Now it really seems like gold is really just kind of channelized and consolidating at this point, especially over the last, for most of the year. We had this big rollover here in the middle of January, and it hasn't done a whole lot since then. Now, usually we see when we have big upheavals in the market, whether it be to the up or the downside, in my experience, we've typically seen some movement in gold because people view it as a hedge against, inflation, against volatility, things of that nature. But gold is really just kind of sitting here, Riz. What is this telling us overall?
Yeah, gold is kind of been moved to the side, kind of like the ugly stepchild type of thing with crypto coming and Bitcoin being kind of like the next virtual type of gold thing. But gold is here to stay. It's not going anywhere. It's an important commodity. Uh, I feel on a technical standpoint, $1,800 an ounce area is a good support zone. Am I buying it right now or even during if it gets to 1,800? Not yet, not yet. I find there's more opportunity, better opportunities in equities in different sectors and markets compared to just having gold. Having a certain percentage of your broader investment portfolio or assigning a little bit towards it is fine. Um, so that's okay, especially with inflation being stealth. We're not seeing inflation kicking in the broader view, but we are seeing some inflation in specific areas, right? So that's something we continue to monitor, but it's not mission critical yet. It's not like we're seeing Venezuela type of thing. Okay, so don't worry too much. Anytime I mention the inflation word, people start getting, this worry that it's extreme. Again, an extreme level. But inflation is there. Inflation is a completely normal thing. In fact, the Federal Reserve is aiming for a little bit higher than 2% inflation. That's their kind of target, right? That's where they want to go with money supply, and I think that's fine. 2 to 3%, it's fine, uh, and it's not going to change fast. Inflation is a metric that is looked back, right? So every quarter that goes back, we look back where it was, and it's a very slow moving thing. Okay, so nothing to be worried about just yet, and we're going to continue to monitor. I think 1,800 is the next area for gold. Otherwise, it consolidates. I don't see it getting it back to around 2,000, 2,100 area anytime soon. But yeah, that's kind of my brief synopsis of gold.
Okay, well, you mentioned the dirty C word, and so I guess we might as well take a look at it. That would be cryptocurrency. Let's take a look at Bitcoin. What has been going on with Bitcoin? It looks like we've had a sharp rebound here off of the 50 moving average, or this critical support area of around 30,000. That seems to be kind of an area for Bitcoin right now that it just does not want to push down below there. Obviously you can see with these wicks on these candles that yes, it can trade below there, but there was enough buying power down there to push it back up over that 30,000 area. And of course, guys, always remember crypto is being traded 24/7, 365, which is why you see the clock going here and you see the price moving as we are talking. What are your thoughts on crypto right now, Riz? There's obviously a lot of buzz around it with this huge meteoric rise in Bitcoin after it kind of languished for about 2 years, I would say. Got a really huge push up in here. Is there something else going on, or do you think that people are just still on board the hype train?
Yeah, so I wouldn't call it just purely hype. I guess obviously there's demand, and of course everyone who is a fan of crypto will tell you right off the bat, Bitcoin specifically has limited supply of 21 million max coins. I think what the market individuals, I mean by when I say the market, I mean individuals globally have flocked to cryptocurrency as a means of speculation, but also as a means of kind of a belief or a hedge against the system, against fiat, against a centralized currency as a whole. So that's fine. I do understand why people would be interested and why they would kind of want to adopt this. Right now, it's way too in the speculative realm to be if you want to call it a commodity, right? I think I would identify it more as a commodity, as a currency, because right now the utility is in there. It's still way too volatile to be a currency per se. So I look at it as somewhat like an alternative commodity. Even though I don't hold any crypto anymore, I've publicly stated that many times. I do not intend to buy any anytime soon either. That's just me personally. But I do understand why, if anyone on an individual level or even on an institutional level, if they decide to allot 1, 2, 3% of a portfolio or a fund to an alternate commodity or asset class like crypto, specifically Bitcoin or Ethereum, right? So it's just become more and more mainstream. And I think if the last week has said anything, stocks and markets have also become a lot more mainstream with all that's occurred. Now, whether that's a good or bad thing is a different story, but it is what it is, right? We've seen massive amounts of inflow, I should say, in interest in markets, and the same has been for crypto as over the last few months.
Absolutely, guys. Just be careful. That's all I'm going to say. That's what I always caveat crypto with, is just be careful, guys, and don't go all out. Okay, don't be dumping your whole portfolio into Bitcoin. It may not work out for the best. We'll just leave it there. All right. So talking about that, I think we have to address the elephants in the room. We already kind of talked about them a little bit. Let's get to this. All right. Now, of course, our chat room has been a flutter with discussion of GameStop. I want to play a video here so that you guys, there's been a lot of chatter. I mean, there's a lot of misinformation out there and a lot of misunderstanding. But I have an interview from the chairman of Interactive Brokers, which is the brokerage that we use in the hedge fund, was talking about what was going on with GameStop and why certain brokerages restricted trading in that ticker. So let me grab this video here from YouTube and we can all watch it together. It's not too long. It's only about like 4 minutes, I think. 4 minutes and 17 seconds. So I think we can handle that. So let's watch this together, and then I want to talk about it with Riz so that we can kind of clear the air about some things.
And names like GameStop and AMC. Joining us now in a first on CNBC interview, Interactive Brokers Chairman and Founder Thomas Peterffy. Thomas, thank you for joining us. It's great to have you on a day like today to help clarify what is going on. So explain to us, to our audience, why you have decided, like Robinhood, to restrict trading in shares of these companies like GameStop and AMC.
So simply put, we are worried about the integrity of the marketplace and the clearing system. This is a new scenario in which fundamental values do not matter. Stocks that are worth single-digit dollars go to several $100s. For example, Game today jumped up and down hundreds of dollars at a time. We are concerned about the ability of the market and the clearing systems to withdraw the onslaught of orders, to continue to provide liquidity, and we are concerned about the financial viability of intermediaries and the clearing houses. Now, I hope that your audience can follow this. For every option trade, there's a buyer and a seller. There are as many long options as there are short options. So when the stock moves either way, some options make money on one side, and the other side they lose money. The broker stands between his customers and the clearing house. So when some option holders make money, the clearing house has to give us the money to give it to our customers, while other option holder sellers or buyers on the wrong side lose money. We have to collect money from them and give it to the clearing house. If our customers are unable to pay for their losses, we have to put up our own money. Now, luckily enough, we have $9 billion of equity, so we don't have a problem. And we also have a very well automated risk management system, so we haven't really gotten hurt. However, I cannot say the same thing with full confidence about other brokers. I really don't know where they stand, so I'm extremely concerned. As Game moved from $17 to $500, there are roughly 3 million contracts outstanding in the options market. If one of those options is worth, say, an average option I estimate worth about $10,000 now, so that is a loss of roughly $10 to $15 billion on the one side and $10 to $15 billion of gain on the other. I'm afraid that there may be brokers who may not be able to meet these margin calls. So that is the...
So just to be clear, you're worried about the middlemen. Are you doing this move to protect yourself or to protect your customers?
Partly to protect ourselves, but mostly to protect, of course, to protect our customers, but most of all to protect the marketplace, to protect the clearing house. So if there are 10 to 15 billion dollars of losses in there, somebody has to pay them. Will they be able to pay it? It's the big question.
Thomas, do you understand people's anger, your customers' anger, given that essentially you changed the rules of the game right in the middle of the match, at the most important moment in the match? Even if your terms and conditions allow you to do that, do you understand their anger that you changed the terms of trade for them just as things were getting heated up?
I do, but when you say right in the middle of the game, then you're saying as the squeeze is going on, stronger and stronger. But that's illegal. That's manipulative. So it cannot be done.
So do you think...
Also, I think, somewhat responsible for what our customers are doing.
All right. So there has been a lot of outcry on the web, on forums, on YouTube, wherever, Reddit, Discord, everywhere. Everybody's crying foul. Everybody's saying that, they're fixing the game, that they're squashing the little guy. You hear it all. You hear all the conspiracy theory about what's going on. And I think one thing that Riz and I want to talk about tonight is to really kind of clear the air and get you the real information so you understand what's really going on. So Riz, we heard that from the chairman of Interactive Brokers. Break it down for us a little bit so we can understand that a little bit better, because I understand there were a lot of big terms thrown around in there that, if someone's new to the market, they may be like, well, they're just fixing the game so we can't win. What's really going on?
Right. I'm glad you brought this up. I'm glad you played that video for everyone to see, because it's very important to understand. I think Thomas Petterfy didn't, I would say, do a great job or do himself any favors or Interactive Brokers any favors by kind of saying what he did, just because the way he said it. But what he's trying to say is, as someone who's worked in banking and finance and investment industry, I can tell you that there is many moving parts when you buy a stock or when you sell a stock or whether you short a stock. Same applies with options. There's many moving parts. You have the brokerage. You mentioned the word clearinghouse. What's a clearinghouse? When you place a trade, the brokerage facilitates the order directly to the exchange, right? Whether it's the options exchange, whether it's the stock exchange, right? Whether it's the New York Stock Exchange, whether it's the NASDAQ, whatever. There's many intermediaries at play. Obviously, in electronic trading over the last 20, 25 years, it's become very seamless, very quick, but there still are core factors at play. So when he mentions clearinghouse, the clearinghouse is the one that needs to clear the trade. They need to effectively, they're the ones that are effectively receiving the money and sending the money. They're effectively doing the reconciliation. Right, and I apologize for these big words, but there's no other way I could say it. If you are buying GameStop and I am selling the shares, well, that's a transaction taking place. The brokerage is involved in that they got to route the order to the exchange. The exchange is the one that's providing the real-time data, the pricing information. The clearinghouse is the one at the end of the day, right? It's going to be like, okay, one person sold for $325, another person bought at $200, okay, that's a difference of $125. Who made what? That's the clearinghouse. And the clearinghouse needs to provide the money or take the money from the parties. The brokerage needs to be able to facilitate that and make sure that they have the liquidity. Because what happens if, Chris, you bought the stock, okay, at 200, and now the price is, dropped, it's tanked, okay, to 100. You went too big. And you can't meet the capital requirement to effectively provide the brokerage. You're going to get margin called because you lost so much money. You did it on leverage. Guess what? That leaves Interactive Brokers out of money if you can't meet the margin call. Because when you are leveraged, especially if you're playing with options or where you're using more money than you actually have, right? That's what leverage is. That's what margin and buying power is. And these brokerages extend you that. They extend you that money. And if you aren't able to meet that, guess what? Interactive Brokers is unable to provide liquidity and provide the money to the clearinghouse. So notice how it's a domino effect, right? The word liquidity is very commonly used. And I don't think there's a scenario where, we have a liquidity crisis. It's not like that. So it infuriates me when people on WallStreetBets, when people on Reddit and social media and Instagram and YouTube, they have no fucking clue what's going on. They have no idea what they are doing and how it works. They're just using it. And then the worst part is they pretend like they know. They don't understand that there's many different pieces. It's like a cog. It's like a machine. You remove one cog, nothing's going to work properly. You know, if you have a car, okay, a combustion engine. I know a lot of people are about EV and electric, but let's just stay with the combustion engine for a moment. If you remove the exhaust system, you're like, oh, well, you know, it's going to make a lot of noise. Sure, that's one of the immediate impacts. But the underlying effect is it's going to cause a problem with the engine, right? So people are not focusing on the issue that is occurring. The reason these brokerages are stopping trades, one, they are doing it in some way to protect the investor, but that's not the only reason. They're doing it, like Thomas Petterfy said, to protect themselves. What is themselves? To protect the brokerage, okay? Because if the brokerage goes under, what's going to happen with the millions and millions of individuals that have their money there? If the brokerage is unable to meet liquidity requirements, what's going to happen? That means the brokerage is insolvent. They don't have money. Why don't they have money? Not because they did anything wrong, but because people over-leveraged and gambled on a stock that is up 1,700%. And if they did it with margin, that can be a recipe for disaster for the individuals plus the brokerage, and by proxy plus the clearinghouse. So now you have three different things at play. You have two institutions and, of course, the individual trader investor. So this is no longer just us against the hedge funds, us against the short sellers, us against Melvin Capital, us against this or that company, okay? Or this is just ridiculous, and it hurts me because as someone who's done it for 13 years, I'm not going to say there hasn't been, you know, some shady stuff that's happened in the past. I'm not going to say that these brokerages are just trying to look out for the investor, because they're not. Their reasons are manifold, and none of them are simple. And as Chris is showing us here, as he's running through these stocks, that these companies that are they're worthless. They're worthless. I run a better operation, a better business at Riz International than GameStop does. GameStop is a dying business, but it's moved up 1,700%. On what basis? If they ran up Amazon, if they ran up Apple, if they ran up Google, if they ran up Facebook, 1,700%, 1,500%, 1,000%, even 500%, I would understand it. But they have run up a meme stock, a company that is literally a former shell of what it was. You don't have to be a genius. You don't have to be an MBA. You don't have to be a CFA to understand this company isn't all that great. Sure, it might have upside, but by 1,700% in less than 3 weeks? Give me a break. And then for all the people that are going to chastise me, because I'm sure once this goes live, people are going to say, Riz, hold the line, don't sell. Look, ultimately, someone's going to sell, and someone has been selling. You do not get candles like this when no one's selling. And I'll tell you right now, no institution is shorting this thing right now. Okay, no institution is going to be able to, as per their mandate, be able to short this. Yes, institutions have mandates on what they can and can't do. This is something you won't hear in the media. You won't hear the, politicians on Twitter and so forth, like, talk to you about clearinghouses, talk to you about mandates, talk to you about liquidity, talk to you about having a brokerage be solvent so the investors don't lose money, right? Because guess what? If the brokerage does not remain solvent and they let anyone and everyone do whatever they want, and if they have to go under, the individuals are going to lose the money, and who are they going to complain? They're going to say, oh, these people ran off with their money. So you can't win. You can't win against a massive crowd that is, one, pumping, two, is frankly delusional, and three, is uneducated on how this all works. So I wish I could say, WallStreetBets, you're up for the good guy, you're fighting for the little guy. This is no longer fighting for the little man, because if it were, companies like fucking Express and Cost and these companies that are just worthless going up so much would not be KOSS, would not be the case. We'd have companies like Apple going up. You have companies that are deeply undervalued, okay, going up. Not this nonsense that was, $2, $3 going up to $60, $64. It just blows my mind. It blows my mind. A bankrupt movie theater Okay. And I'm not saying it's bankrupt because they necessarily did wrong. It's just the wrong industry and a wrong time because of the pandemic. But it's a fraction of the business what it was 5 years ago, let alone 2 years ago. So does it make sense? Is AMC is one of those plays that's a turnaround play, but to have it go from $2 to $20 so fast, so quickly, that's not sustainable. That's not okay. Whatever happened to price discovery? There's so much nonsense about shorting nowadays, and I'm going to do a completely different video on this because people don't even know what shorting is and what it does to the markets. They don't understand how it's an actual part of markets and price discovery. And I'll touch on that later. But man, this is just painful to see. And I'm telling you, there's going to be a lot of people. There already has been a lot of people that have made money in like these run-ups, whether it's GameStop and whatever. And if you have, that's great. Whether you continue to hold, sure, go on and do so if you think that's what you want to do. But do not, at the very least, fool yourself and fool others with misinformation and things that really aren't the case. Because I'll tell you, as I started off with this webinar, the reality is somewhere in between. It's never so clear-cut and extreme.
That's what I was going to say, guys. But I think Riz did it better. No, I think that this is the important thing because, the whole message that you're seeing on social media, on all of the different channels that you may be part of is like, oh, they're rigging the game against us. It's so that the big guys can keep winning and we can't. We don't have any edge and things like that. And guys, that's not really what's going on here. They're protecting the fact that you still can play in the game. That's what they're doing by restricting access to some of these positions.
And I'll tell you right now, the wording has been horrible. The way they've kind of explained things has been horrible. And that's the brokerage's fault. They just stopped. And many of them had to stop because of the clearinghouses. Many of them had to stop trading because of the exchanges. So some of them had their hands tied. Some of them did it very early, very quickly with no explanation, aka Robinhood. And of course, I know people are going to say, but Robinhood's biggest customer is Citadel. Citadel is a big investor in Melvin Capital. Melvin Capital is the one that shorted GameStop, significantly, and they're the ones who went belly up or supposedly went belly up. So there's that kind of like connection, right? And people are saying, well, it's obvious. And I'm going to say, yeah, sure, I see that. I get that. But let's not go too crazy in thinking that, it's not just that. If Robinhood is one case, but what about all the other brokerages? You think all the other brokerages are effectively making less money? Because remember, when they don't allow you to trade, what do? They make less money because they make less money in rebates from the exchanges. Yes, exchanges want people to place orders through their exchange. And if orders are not coming through, brokerages are not getting paid, right? So would brokerages voluntarily cut the money that they make? No, they're doing it because one, they're forced. Two, they have to look at the viability of the brokerage, right? They have to look at the viability, right? So it's not as simple as us against them and the big guy is ripping off the little guy and it's rigged and, it's not that simple, I assure you. And whether people disagree with me, because I frankly don't care, because the only people that are going to disagree with me is because they don't know any better. It's as simple as that. I'm unapologetic to those that have no business or idea talking about subjects that they do not have a semblance of clue about. They have no idea what is going on, yet they have a platform or they have a voice. Free speech is fine. Spreading lies and bullshit is not. So, you know what? People will chastise me. That's fine. They'll say, you're a shill or you're just on the side of the funds. No, I'm not. I'm not favored towards any institution. I'm not biased or I'm not, in cahoots or tied to any institution. Nor am I, tied to the hip with WallStreetBets or anything. I am taking a completely objective and unbiased kind of view on this, because as someone who has skin in the game, as someone who's made money, lost money trading so many thousands of different stocks, I can tell you that this is a very, very black swan event. This is a negative. Ultimately, whether people make money or not is irrelevant because people have been making money and losing money since the beginning of time. What's negative is the perception of markets. If people believe that markets are rigged and the big guys out there to screw them, guess what? That perception will have a negative impact, right? It may not have a negative impact on the price of the S&P 500 dropping 2%, but it will have a negative impact in the belief of the system. And if that's shaken, if that is what's happened, people will not participate. And we already know the financial markets are one of the greatest constructs of mankind. I've said this, I believe it. And they are one of the best ways to grow your wealth. And if people lose faith in a system that has done so well for them, just because of GameStop or AMC or whatever, then that's their loss. But dragging down the system and dragging down this thing that has provided and done so much for millions just because of what's occurred the last 2 weeks and throw it all away, I think that's foolish. That's foolish.
Very well said. Very well said. And yeah, guys, I mean, it's been a sobering week, to say the least, as far as everything that's been going on, as far as that's concerned. And as Riz said, I think this really is kind of a negative perception at this point. And it's something that we need to, as traders, be aware of that.
And here's another thing I'm going to chime in with. Everyone's like, fuck the hedge funds and whatever. And I get that, hedge funds aren't some, charity. They aren't necessarily a good guy, but they're also not some evil entity either, right? They perform an important part of the market structure, which is price discovery, which is effectively very crucial, right? People are blaming hedge funds for 2008 when that's not the case. Again, another problem of people not knowing what the fuck they're talking about. If they blame the banks, I would understand. If they blame the underwriters for mortgages, for homes, that is true. But blaming just someone who's a bystander, hedge funds weren't the one that were betting against, the housing market. Not all of them. There was only a handful that were part of it, right? The banks got careless. The underwriters got careless. Investors got careless because you could effectively be, a landscaper, a freaking stripper, or someone who, pulling tricks on the street, and you could have 2 or 3 homes. That's not the fault of the hedge funds. That's the fault of the banks. That's the fault of the investors for getting greedy. And that's the same shit that's happening now. So this is reality that needs to be told. People need to understand that, because forget this whole you against me and us against them, because that is not how society, how individuals progress. And I've always said that since the beginning, and it still applies.
Very well said. Very well said. Guys, I think we'll go ahead and leave it at this for this evening. I think this was a really informative, really eye-opening webinar for everybody. And I think this would be a great spot for us to call it an evening. It's been really great having everybody here this evening. I really appreciate it. And Riz, thank you so much for coming in, really shedding some light on everything.
Yes, I'm very passionate about what I do. I'm passionate about what this is. One thing I forgot to mention was if WallStreetBets, if it's individuals on social media or whoever, I don't care, if they think that they haven't been used and haven't been used as a proxy for other hedge funds, multi-billion dollar hedge funds, if they haven't been used to make a lot of money, then they're kidding themselves, because I easily can scrape data off of WallStreetBets and see what's hyped and what's moving and what's talked about. You think hedge funds that manage hundreds of millions and dozens of billions of dollars haven't ridden up this GameStop and other stock hypes? No, they absolutely have. So WallStreetBets, as much as they like to think that they're for the little guy and they want to stick it to the hedge funds, I assure you they have helped hundreds, if not thousands, of hedge funds for every 1 or 2 that they've harmed. So what does that say? What does that say about this whole thing? What a shame, right? They are not looking at, or people are not looking at what's happened. They made more money for these institutions than they've actually lost. So it's so ironic. It's so ironic.